responsible for marketing and client services. Steve?
Thanks, Phil. Well, I'm going to talk about bonds. I saw the big chart here from $10,000. I was in grade 1 in 1960. I didn't have $10,000, but I'm sorry I didn't, because maybe I wouldn't have to be here. But I guess we're going to get the dull and boring stuff out of the way to begin with. And many may have seen in the previous year, we've been running that Foyston and Payne. We've been running the bond fund for Tradex since March of 2011. In April 2011, under Blair's guidance and the committee's guidance, we decided to tweak the fund a little bit. It wasn't just going to be purely bonds. We're going to add some preferred shares and some higher yielding common equities, because it was a period of very low interest rates. So as the search went out for a manager that could offer both a strong bond advantage, and my background is in bonds, I was originally at Foyston and Payne as the bond manager, but also to add some additional yield for taxable investors and some non-taxable investors as well, adding that yield through higher yielding common stocks and some preferred shares. So we're considered value managers. We've been around since 1980. We started as a value manager managing high net worth individuals' money, and then we've branched out over the years into managing pension funds, endowments, foundations, and mutual fund type investments for Tradex. We're always considered a value manager. We're trying to buy good quality stocks. We are buying good quality stocks at discounted values. It's sort of like trying to buy a Lexus for the price of a low-level Chevrolet. Sometimes that works, sometimes it doesn't, but over long periods of time, we really believe that that's a very successful strategy, and it's been proven out in our main equity and bond funds over time. Our managers are all behind the product, where we all buy our own funds, so we eat our own cooking. And as you can see, the Tradex fund, it's a very low interest rate environment. Everybody wants more yield, but nobody wants to take a lot more risk. So what we're trying to do is sort of find a happy medium between taking a little more risk, but not as much as a pure stock portfolio, but at the same time generating a higher income return, trying to get that return so we're not having these ups and downs in the price of the market or the price of your units, but at the same time, over time, being able to generate more income than you would from a pure bond portfolio, especially at these times when interest rates are below 2%. So as you can see, since inception, the return on the fund's been 6.8% compared to 6.3% for our bogey, or what we call our benchmark, the Canada Universe Bond Index. And we feel that's been a solid return over the past year. Obviously, we've been a little bit behind the index, 7.4%, still a solid return, but at a much lower level of risk than you would assume just being in a pure bond portfolio. And if you look at the bottom, you can see the amount of income yield. The yield on your fund right now is 3% compared to 1.7% for the Canada Bond Universe Index. As you also can notice that in periods when interest rates rise, as you can see in 2013, the second half of 2013, interest rates went from about 1.5% on the 10-year government of Canada bond to 3%. You can see that your fund, with the inclusion of the preferreds and the higher yielding common stocks, substantially beat the index by about 4%. If you want to take a more current example, it's not shown here because that's year to date, but if you look at when interest rates since the early February of this year to last night have gone up, and your fund, despite it having a small negative return, has beaten the bond index by about 2%. So it's doing what it's designed to do. It's trying to do well in an up interest rate environment, at the same time as trying to generate a higher rate of return on your income yield as we progress through time. Because that's where a lot of your returns got to come from. It's got to come from income thrown off from the portfolio and reinvestment of that income in the portfolio. We like to keep it well diversified. This is the tweak. As you can see on the right, the FTSE TMX Canada Bond Universe is just bonds. On the left, this is your portfolio. As you can see, we have about 18% in higher yielding common stocks, preferred shares at 9.5%, corporate bonds, and government bonds. So that selection, that diversification, evens out some of the volatility of the fund. So the more and different types of assets you add into the fund, the more diversified it is, the less the volatility you're going to get. You're not all concentrated on just an interest rate event. You're also concentrated on some events in the stock market as well. And that seems to have worked. As you can see, bonds are about even with the index since inception, but preferred shares and common equities have considerably added to the return of your fund, at the same time as keeping risk in the total fund quite muted. So what about our strategy? Lots of stuff going on in the world today. A lot of major stock markets, it's a matter of debate, but a lot of people say the major stock markets are at highs. And a lot of them are, or at reasonable highs, ready to do that. In real terms, the highs, but in nominal terms, a lot of the major stock markets of the world are at highs. At the same time, the central banks of the world have been really worried that growth hasn't been very good since the Great Recession of 2008 and 2009. So the solution is, let's throw a bunch of money at the problem and see what sticks. So what they've done, is you read a lot in the papers, is quantitative easing. That means bond buying, injecting huge amounts of funds into the financial system with the hope that the banks will eventually lend that out, because the banks are selling the bonds to the central bank. They're taking the proceeds and allegedly lending them out, which they haven't been doing because they're a little bit nervous about getting paid back if they do loan out that money. So that money has been driven into the stock markets of the world. The U.S. was the first to dabble in the quantitative easing market. They finished doing quantitative easing early this year. But other central banks like Japan, the European Central Bank, with all its problems of Southern Europe, have decided to do major increases in bond buying. In fact, the European Central Bank is probably going to buy the entire amount of additional bonds issued in Europe in this coming year. That's how strong this has been. And it's resulted in negative interest rates in parts of Europe. The German bonds, German government bonds from 1 year out to 7 years yield a negative rate of interest. If you're investing in a German bond from 1 year to 7 years, you're actually paying the German government to take your money rather than receiving money from that. So there's a lot of distortions in the market. We feel that this is a time not to be very aggressive. We feel that some of the value of the stock market isn't based entirely on earnings, or in fact earnings have slowed. It's basically this monetary injection that's keeping the governments going. As well, interest rates are very low. So bonds in total at less than 2%, a 10-year Government of Canada bond is 1.4% today. That's not promising a huge amount of excess return over time. If you look at a long Government of Canada bond, below 2%. If interest rates were to increase 10 basis points, that's 1/10 of 1%, you would have a negative rate of return on your bond for the year. If they just went up 10 basis points and stayed there, you'd have a negative rate of return. That doesn't, to us, appear to be great value from a longer-term perspective as longer-term buyers. So we're very cautious. We're adding bonds to protect some capital into the portfolio. And as well, they do help diversify against the risk of the stock markets going down. But we're really finding a lot better value in the higher yielding common stocks and certain sectors of the preferred share market. You've probably heard a lot about Great Reset preferreds that have done very poorly. They probably are right now offering really great value. We've avoided those, and that's why our preferred share sector of your portfolio has done extremely well over the last year. But we feel when there's those times in the market when there's outliers, when something is really oversold, it's an orphan in the market, nobody wants it, those are the times that we like to go in and say, gee, that's a really advantage from a longer term perspective, and we're willing to add those to the portfolio. And that's what we're planning to do over the next year. So we're remaining cautious, being selective in our stock market picks, but we're really confident that we're positioned in your portfolio to have a positive risk-adjusted return. Concentrate on the risk, because we're not only there for total nominal return. We want to make sure that your portfolio risk, the volatility of your portfolio, is fairly constant. We don't want to have huge swings in the capital value of your portfolio. And at the same time, we want to make sure that we have a decent yield to add to your portfolio, which will help you outperform over a long time period. questions? Yes, sir.
What sort of impact do you expect based on the Bank of Canada's actions on the bond market and on equities?
What type of,
What sort of impact would that have on the bond market? You say it's adding to volatility and it's not very clear.
well, the Bank of Canada's really been following a policy of a low dollar. I was telling the committee today that when my mother didn't like something to change the brand of ice cream she liked from vanilla to butter pecan, she said, I'd had that. And I know it's Ottawa and it's meant to be a partisan crowd, but we probably had better Bank of Canada governors. He's really added a lot of uncertainty to the market by his waffling back and forth on the direction of short-term interest rates. For a Bank of Canada to come out and governor to come out and say we need a lower dollar, that's really not. You know, I lived through I was trading bonds through the high inflation periods of the late 70s, early 80s. If a governor came out and said that right then, that would have been the end of the bond market. You know, at the time it seemed like it was going to be the end, but it would have been the end. So that impact is a reason why we're having a shorter term duration. There's not a lot of inflation in the rest of the world, but we're starting to see some signs in Canada. And basically, you don't want a lot of bonds if inflation goes up, because bonds hate inflation. And if inflation goes up, bonds are going to go down. So he's really the governor has really been a bit of the wild card, and I think right now it'll be a negative impact. Maybe the dollar will go back up if we can see a large commodity price rally, if oil prices go from $50 back to 100. But in the near term, we really don't see that. So there's a risk that we're going to stumble along here on growth, but at the same time, inflation with the declining dollar will probably pick up, and we're better off skewing the portfolio a little more towards stocks rather than bonds. Yes, sir.
The question of Greece, and if Greece exits the euro, is that going to affect your investment philosophy, or will that have a big impact on the world, or can we just simply ignore it as something for Europe to advance?
That is a $64,000 question. You're absolutely correct. You've summarized the whole debate, whether it's Greece is such a small portion of the euro economy, or there's going to be this domino effect. One country excess is exposed, and so the next will be Spain, and after that Portugal. The corporate view is basically it's not as big a deal as a lot of people are making it out to be. Bigger things are like the Ukraine. That could really cause problems for Europe. If Greece were to exit, it depends on how they exit. Are they going to default, or are they going to be thrown out? Unlikely they'll be thrown out. It's just not the political will to do that. It would obviously affect German rates are already negative, as I mentioned. That would probably drive people more towards Germany and potentially more towards North America for safety. So there is that effect, but interest rates are so low as it is, it's unlikely that it's going to be big enough effect. But there's going to be a shock from somewhere that's least expected, and there's a lot larger economies that would have much more of an effect. Yes, sir.
We talked about central banks pumping money into the economy, which is driving interest rates down lower. Where is the market? What's happening with the market? Because generally speaking, we've seen things like the pound sterling is never going to be devalued, but the market made it. Is the market going to come back and raise those interest rates up?
If you see inflation, the central banks can only control the short-term interest rate. If you're seeing inflation, the markets, what they call the bond vigilantes, will start to sell bonds. Right now, it's hard to see in Europe because the central banks have control of bonds. In North America, what's really happened is the central banks have bought a lot of bonds from the charter banks, from the banking system, the city banks of the world. That's gone into reserves. Reserves are sitting there, they're saying, well, I've got so many capital controls, so many changes in my reserve requirements that I basically am better off just buying some stocks with this money. It's a low interest rate environment. So that's right now what's propelled these stock, even though the earnings are forecast to be negative 0.6%. They were negative 5.6% three weeks ago, now they're negative 0.6. There's no real valuation basis for the height of the stock market right now. Now, maybe if the stock market gets stronger, the economy gets stronger, then the bulls will be the most positive people in the market will be vindicated. But it's tough to see where you're really going to get an earnings support for the major stock markets over the next little while. Did I answer your question, or?
No.